So today I want to talk about something super important, something I wish someone had told me years ago. It is about how I messed up with money. Big time. I mean, we are talking about losing a good chunk of my hard-earned savings because I thought I was smarter than the market. Spoiler alert, I was not even close. When I was in my early 20s, I was just like many of you, I guess. I had this burning desire to get rich quick. I saw friends, or rather, people on social media making what looked like easy money, and I thought, why not me, right? The truth is I had no idea what I was doing. My financial education was basically zero. My approach was see a hot stock, buy a hot stock, hear a rumor, jump in with both feet. It was pure madness. I remember this one time. Vividly, I had saved up a decent amount, enough for a down payment on a small apartment, I thought, but then I heard about this stock. Everyone was talking about it. It was going to the moon. They said I did not do any research. Nothing. Just FOMO, fear of missing out. Pure and simple. I dumped almost all my savings into it. Within a few weeks, it crashed. Not just a little dip, a full-blown catastrophic crash. I watched my account balance evaporate. It was brutal. It felt like a punch to the gut, that feeling of regret, of knowing I had thrown away months, years even, of hard work. It was soul-crushing. That was not the only time. Unfortunately, I got sucked into short-term trading too. Buying and selling quickly, trying to catch those tiny daily movements. It felt exciting, like a game, but in reality, it was just gambling with extra steps. I spent hours staring at charts, stressing over every tiny fluctuation. My sleep suffered, my relationship suffered, and my bank account suffered most of all. I would make a little profit one day, feel like a genius, and then lose twice that the next. It was a vicious cycle of emotional highs and crushing lows, and then there were the scams. Oh, the scams. When you are desperate to make money, you become incredibly vulnerable. I fell for a few too. There was this one, a supposed high yield investment platform. They promised insane returns, way above anything realistic. I put in a small amount first just to test it. It paid out a few times. That built my trust. Then I put in a much larger sum. Poof, gone. The website disappeared. The contact person vanished. It was a painful lesson in due diligence and trusting your gut when something sounds too good to be true. It usually is. I also made the classic mistake of not understanding risk management. I would put too much money into a single asset, what they call going all in or heavy weighting. I thought, if this one takes off, I am set, but if it goes south, well, you are completely exposed. There was no diversification, no thought about protecting my capital, just pure unadulterated hope and a complete disregard for the downside. It was a recipe for disaster, and it delivered. My emotions were all over the place. I would buy out of greed, sell out of fear. I was constantly chasing the market, reacting to headlines, letting my feelings dictate my decisions. It is amazing how irrational we can become when money is involved. I remember checking my portfolio probably 100 times a day. Every dip sent me into a panic. Every small rise made me euphoric. It was exhausting and completely unproductive. Emotional trading, I learned, is almost always losing trading. After losing what felt like everything, I hit rock bottom financially. It was a wake-up call, a very loud, very painful one. I had to face the reality that my approach was fundamentally flawed. My get-rich-quick mentality was actually making me poor. Slowly but surely, it was a tough pill to swallow, admitting I was wrong, that I had been so naive. But that low point was also a turning point. I decided enough was enough. I stopped chasing the fantasy of overnight wealth. I started reading books, watching educational videos, learning about proper financial planning, real investing, not speculating. I learned about things like asset allocation, diversification, long-term growth, and the power of compound interest. These were not exciting topics at first, not like the flashy stock picks I used to chase, but they were foundational. They were the building blocks of real wealth, slow and steady wealth. I ditched the idea of beating the market. Instead, I focused on participating in its growth. I moved towards more stable, low-cost index funds. I started building an emergency fund. I paid down debt. I began to understand that financial security is not about hitting a jackpot, but about consistent, disciplined saving and smart, sensible investing. It is about playing the long game, not the lottery. My mindset completely shifted. I stopped seeing investing as a race and started seeing it as a marathon. I stopped trying to time the market and started focusing on time in the market. It was a huge mental leap, letting go of that desire for instant gratification and embracing patience. So now, I am here to share my mistakes, my hard-won lessons, so you do not have to go through the same pain I did. My goal is to help you, especially if you are in your 20s and just starting out, navigate the confusing world of money. I want to give you the basic principles, the bottom line thinking that can help you avoid the pitfalls I stumbled into. Here is the deal. If you are new to investing, or even if you have been around for a bit and are feeling a little lost, remember these things. First, educate yourself. Seriously, before you put a single dollar into anything, understand what it is, how it works, and what the risks are. Do not rely on tips from friends or random internet gurus. Read reputable books, take legitimate courses. The more you know, the less likely you are to be fooled. This is not about getting a fancy finance degree. It is about understanding the basics, the language of money, and how different investment vehicles actually function. Think of it like learning to drive. You would not get behind the wheel of a car without knowing how to accelerate, brake, or steer. Investing is no different. You need to know the controls before you hit the road. There are countless free resources available online, from reputable financial institutions to educational platforms. Take advantage of them. Your future self will thank you. Second, avoid the temptation of high returns. If someone promises you guaranteed huge profits with little to no risk, run. That is a scam 99.9% of the time. Real investments have risk, and realistic returns are usually modest, especially over the short term. Be skeptical of anything that sounds too good to be true. It always is. The siren song of quick riches is what lured me into so many bad decisions. I wanted to believe that there was a shortcut, a secret formula that would make me rich without much effort. That is a dangerous fantasy. Wealth building is a marathon, not a sprint. It is built on consistency, patience, and realistic expectations. Do not let greed cloud your judgment. Remember, if it sounds too good to be true, it absolutely is. Third, start small and diversify. Do not put all your eggs in one basket. Spread your investments across different assets, different industries, different types of companies. This reduces your risk. If one investment goes south, your entire portfolio is not wiped out. Think of it as a safety net. When I was starting out, I would put all my money into one stock, hoping it would be the next big thing. That is pure speculation, not investing. Diversification means owning a variety of assets so that a poor performance in one area does not cripple your entire portfolio. It is like building a strong, stable table with multiple legs instead of just one wobbly one-fourth. Understand risk. Every investment has some level of risk. Your job is to understand what those risks are and whether you are comfortable with them. If you cannot sleep at night because of your investments, you are probably taking on too much risk. Your financial peace of mind is worth more than chasing an extra percentage point of return. I learned this the hard way, through countless sleepless nights and constant anxiety about my portfolio. It is crucial to assess your personal risk tolerance. Are you someone who can stomach big swings in the market, or do you prefer a more stable, albeit slower, growth path? There is no right or wrong answer, but you need to be honest with yourself. And always remember that historical returns are not a guarantee of future results. Fifth, think long-term. The stock market historically has gone up over the long term, but it also has ups and downs. If you are investing for short-term gains, you are essentially gambling. If you are investing for the long term, say 10, 20, 30 years, you are giving your money time to grow and recover from any temporary dips. Time is your biggest ally in investing. This was a massive shift in my own thinking. I used to obsess over daily price movements, trying to predict what would happen tomorrow. Now, I barely look at my portfolio more than once a month. If that, my focus is on the decades ahead, not the next quarter. The power of compounding returns really kicks in over longer periods, turning small, consistent investments into substantial wealth. Do not underestimate it. Sixth, control your emotions. This is probably the hardest one. Do not let greed or fear dictate your investment decisions. Develop a plan, stick to it, and do not check your portfolio every 5 minutes. The market will fluctuate, that is normal. Reacting emotionally will almost always lead to bad decisions. Set it and forget it, at least for a while. Emotional investing was my undoing in my early days. I would buy when everyone else was buying, driving prices up, and then panic sell when the market dropped, locking in my losses. It is the opposite of what you should do when the market is down. That is often when the best opportunities arise, if you have a long-term perspective and the courage to act. Cultivate a calm, rational approach. Your portfolio will thank you. Seventh, regularly review and adjust. Your financial situation will change, your goals will change, your investments should reflect those changes. Periodically review your portfolio and make adjustments as needed. This is not about constantly trading, but about ensuring your investments align with your current life situation. Life happens. You might get a new job, get married, have kids, buy a house. Each of these life events can impact your financial goals and your capacity for risk. Your investment plan should not be static. It should be a living document that adapts as your life evolves. A yearly or bi-yearly review is usually sufficient. Eighth, never invest money you cannot afford to lose. This is a golden rule. If you need the money for your rent, your groceries, or your emergency fund, do not put it into the stock market. Investing should only be done with discretionary income, money you are prepared to part with if things go wrong. An emergency fund, usually 3 to 6 months of living expenses, should always be your first financial priority. It acts as a buffer against unexpected events, preventing you from having to sell investments at a loss if you suddenly need cash. Without a solid emergency fund, you are building your financial house on quicksand. Ninth, remember that everyone makes mistakes. I certainly did. The key is to learn from them and not repeat them. Do not beat yourself up. If you make a bad investment, it happens to the best of us. The important thing is to understand what went wrong and use that knowledge to make better decisions next time. My investing journey is littered with bad decisions, impulsive buys, and missed opportunities. But each one was a lesson. I learned what not to do. I learned about my own biases and weaknesses. Self-awareness is a powerful tool in investing. Be kind to yourself, but be honest about your errors. 10th, find a community. Talk to people who are also learning about personal finance and investing. Share experiences, learn from others. Just be careful about who you listen to. Stick to credible sources and avoid those promoting speculative or risky schemes. There are many online forums, local groups, and reputable financial educators who can provide support and insights, but also be wary of echo chambers and get rich quick schemes that often masquerade as advice. Seek out diverse perspectives and always cross-reference information. Learning from others' experiences, both good and bad, can accelerate your own financial education and help you avoid common pitfalls. 11th, automate your savings and investments. Make it a habit, not a chore. Set up automatic transfers from your checking account to your savings and investment accounts on payday. This removes the temptation to spend the money before it can be saved. Out of sight, out of mind. When I started doing this, it was a game changer. I no longer had to actively think about saving. It just happened. This consistency, even with small amounts, builds incredible momentum over time due to the magic of compound interest. Do not underestimate the power of automation. It is a simple hack that can dramatically improve your financial discipline. 12th, understand fees. Fees, even small ones, can eat into your returns over time. Be aware of the fees associated with your investment accounts, mutual funds, exchange, traded funds, and any financial advisors you might work with. Always choose low-cost options where possible. I used to ignore fees thinking they were insignificant, but when you calculate the impact of a 1% fee over 30 or 40 years, it can amount to hundreds of thousands of dollars. Be vigilant about fees. They are a silent killer of wealth. 13th. Do not try to time the market. This is related to controlling emotions, but it deserves its own point. Trying to buy at the absolute bottom and sell at the absolute top is a fool's errand. Even professional investors with vast resources rarely succeed at this consistently. Focus on consistent contributions and stay invested through market ups and downs. This strategy is known as dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out your purchase price and reduces your risk. It removes the stress of trying to predict market movements. 14th, prioritize debt repayment. High-interest debt, like credit card debt, can cripple your ability to save and invest. The interest rates on these debts often far exceed any returns you could hope to get from investing.